Welcome to PM Express Business Edition. Government has finally outdoored its program aimed at restructuring the country's debt stock. However, this initiative has already been facing some serious opposition, especially from organized labor. But it's just coming on the back of the banking sector cleanup, and are we at risk of eroding the little confidence left in the banking and financial space? There are some that are worried that this could end or get into the era where more money could be moving outside the banking sector. And is this really an IMF program requirement? Is there an alternative to this program? What about those who argue that this is a watered-down version of a debt restructuring program? Well, I'll be engaged to connect live with Professor Ofori-Atta. He is an economist. Ofori-Atta is the Executive Secretary of the Ghana Association of Savings and Loans. Seth Alaski is the President of the Ghana Insurance Association. And Thomas Kwesieso is the Executive Secretary of the Chamber of Corporate Trustees, right here in the studios of Joy News as we look at the debt exchange program and its impact on the whole financial sector. All these issues wrapped up here on PM Express Business Edition. Be right back after this break. Welcome back to PM Express Business Edition. We're talking about the debt exchange program and how that could impact on the entire financial sector and the banking space. Mr. Kwesieso is the Executive Secretary of Corporate Trustees. When it comes to management of pension funds, he is live with us in studio here. And Ofori-Atta, he is the Executive Secretary of the Savings and Loans Companies, connecting us via Zoom. And also Mr. Ofori-Atta, he's a professor of economics at the University of Ghana, also joining us via Zoom. And also we have the President of the Ghana Insurance Association. He's also joining us via Zoom. Gentlemen, I appreciate your time so much and good evening. And let me start with you first in the studio. When this whole program was put out, you had some concerns with, are we making any progress with those matter in terms of the concerns that you expressed?
Good evening to your viewers, and good evening to George and your viewers, and good evening to my colleague panelists also. To answer your question, I think it's clear that we have actually come out to state our position on the debt exchange program. And it's clear that we've come out and said that that is not going to benefit us and it's going to be very injurious to the contributors to pension schemes. It's clear we've stated our position very clear. But I can tell you that as at this evening, as I'm talking with you, the expectations that we will engage the Minister of Finance on this, on the way forward of this, we've not had any engagement from the Minister of Finance yet. What have happened today that I'm happy to share with you is that we had an engagement with our regulator, MPRA, and that went very well. We've also laid down our concerns to him, and we've also asked him to take certain actions, which I believe that he's going to take those actions.
Did the regulator give you any insight that, well, these are the concerns that you've raised and we are going to work on it?
I think one of the things that we requested is that he should facilitate a meeting between the industry and then the Ministry of Finance. And I know he's working on that, and I know that he will be able to do that.
Isn't it surprising that you are a critical player in this sector, and in terms of the pre-sector engagement, you were not consulted? Or
that is the surprising thing. I believe that, we all cannot understand why that did not happen. We know very well that a 5-member consultative committee was set up, where we also have a rep on that committee. The committee engaged there somewhere in October and took our challenges and concerns, which we actually enumerated very well. So we thought that before anything should be done, we could be engaged further to see how our concerns have been factored into any debt exchange program. But unfortunately, we didn't have any further engagement on that. The only thing that happened last Friday, like everybody, happened to everybody, including the bankers, the insurance, the fund managers, and us as the pensions industry, was that the program was announced to us on last Friday. Then Sunday evening, we also saw the official announcement. So it's surprising Because if government actually recognizes that the pensions industry are significant stakeholders.
And help us out for the basis of our viewers who might not appreciate your workings. When it comes to these corporate trustees, what do you do? Who are these guys?
Thank you very much.
We know NPR, we know
Yeah,
SNIT.
we know
Who are
SNIT.
these corporate trustees?
Yeah, thank you very much. I think per the new act at 766, National Pensions Act, pensions administration was actually broken into the three-tier that we've all been talking about, the three-tier pension scheme. Now, when you take tier one, which is known as the Basic National Social Security Scheme, is being administered by Social Security National Insurance Trust, SNIT, that we all know. But the tier two, which is also a mandatory scheme, the law makes it mandatory that it should be administered either by a corporate trustee. So these corporate trustees are companies which have been registered registered at the Registrar General's Department, and also have been licensed by the regulator, National Pensions Regulatory Authority, after fulfilling certain qualification requirements. So these corporate trustees are the ones who are entitled to receive the contributions of all, workers, in various companies. If you choose any of the corporate trustees, and then they will manage. Currently, we have about 28 corporate trustees, licensed corporate trustees.
And in terms of your total funds that you're sitting on?
Yeah, so I'll come there. So we have about 28 corporate trustees. So the tier two, which is mandatory, is managed by the corporate trustees. And then we have the tier three, also, which is voluntary. That one is also managed by the corporate. The tier three is in two from the Provident Fund and then the personal pension scheme. That is also managed by the corporate trustees or employer-sponsored schemes. Now, when you take the whole total assets of the pensions industry now, we are at about 32 billion Ghana cedis. 32
and this supposed the perceived haircut will hit you guys badly.
And then if you look at it, that out of these 32 billion Ghana cedis, almost 27 billion are in government bonds.
Wow.
That is about 80% are in government bonds. And so you can understand the effect of the haircut on these pensions industry.
Let me bring in Mr. Septa Classy. I hope I got the name right. He's the president of the Ghana Insurers Association as well. What about the insurance industry? Was there some level of engagement, or it was also a surprise prank on you? Because from government side, they claimed they started the engagement and there was a leak in the public, and that truncated the whole broader engagement that we're going to have. If you can unmute, I'll be grateful, sir.
Yes, good evening, George, and good evening to my colleague panelists. Yes, as the gentleman from the corporate trustees mentioned, we all met the consultative committee led by Mr. Asian, about Asian. And in the discussions, we actually just enumerated our challenges. As per the story that was released by Bloomberg, I believe, at that time in October, it wasn't like government had categorically come out with any position, but then we all sort of there was that uncertainty. And it stemmed from the news item from Bloomberg, which somehow led to the consultative committee, and the Ghana Insurance Association actually met with them and told us our challenges. As you might be aware, I think everybody knows insurance companies, but then we have two main categories of insurers. We do have the non-life insurers, and then we have life insurers. I'll just give a little differentiation over here, which we would build on with time. The life insurers are people who sell products, insurance products, that definitely there will be a claim on. There are two things: the guaranteed benefits, and then there is death. Those things would definitely always occur because everybody dies. So if you buy a life insurance company at some point, you make a claim. The only difference there is that we do not necessarily know exactly when that claim is going to happen. So that is the fortuitous nature of the life companies. Then we have the general business or non-life. Those are what we refer to as short-term policies, where we are saying that, okay, the pool has been created, a chunk of people will draw from it, or they'll make a claim, some will not make a claim. And at the end of the period of insurance, those premiums would have been earned as a result of what might remain in the kitty, or we might record losses because we would have paid out more than we have recorded. So those are the two mainstream insurance types that we have. So as we go along, our challenges would actually be greater.
Mr. Classy, and help me out. Looking at what government has proposed right now, that it's an offer starting December 19, that if you should take up or if you should subscribe to that, the 0% 2023 and the others, how bad would that affect your members going forward if the whole bond exchange program in its current form is accepted by your members, and how that will impact the industry?
Okay, effectively, we are regulated by the National Insurance Commission. What government is putting out, it might as well just then come out to tell insurance companies, okay, all of you close camp and go home, because then there isn't an industry again if it goes ahead with this plan.
And come again, I some clarity. If this current plan is implemented, do I get that it's just about closing the entire insurance industry?
Definitely.
Wow.
The government is telling us that, because here is a business that we take fractions in premiums and we pay out whole numbers. I earlier on explained that there is the life aspect, where we actually know that definitely there's going to be a claim that is made. People take policies like guaranteed. If you take George, we take it that maybe you took a policy for maybe 7 years ago, because you're a big journalist. We say that you took a policy with an endowment, maybe 1 million. 7 years ago, you have been paying premiums for the past 7 years, where we had guaranteed that after 10 years, you're going to get 1 million. Or touch wood, if you drop dead now, we'll pay your beneficiaries 1 million. It's based on an investment principle or the investment climate to say that maybe the discount rate or interest income would actually build up to that 1 million. So if 7 years you've paid your premiums where insurance companies have invested, and it is not like we really had a choice. Our regulator mandated us that if you do not invest in government of Ghana instruments, then they are not even recognizing your solvency regimes, which is as to whether you're liquid enough to pay claims or not. Then, touch wood, you drop dead now. We haven't gotten to the 10 years for you to claim the 1 million, but that 1 million will have to be paid now. Imagine we go back and tell your family that, okay, because for the next year, we are not getting any interest, and then subsequently we are getting 5%, we are going to reduce that because we couldn't have earned the 1 million, or we couldn't have gotten returns for the 1 million. How are you going to take it? Would people now go ahead to buy insurances? So effectively, what government is doing now is that if there are no interest incomes, accrued interest, then you might as well just tell insurance companies that, okay, for this period that we are going through economic challenges, we don't have an industry called insurance again. So all of you close camp and then go home. The attendant, unemployment, and all the other benefits, where I'd always sort of like give a certain scenario where I jokingly get to tell people that it is poor people who actually buy refrigerators or deep freezers. Because if you're poor, that's when you're going to the market to buy foodstuffs to come and store and then get to cook it gradually. If you really have a lot of money, you go to the market every day, you cook everything fresh. So effectively, I might need a refrigerator to keep anything. So is insurance. At the time that we are talking about difficulty in an economy, that is the most important time that our assets and our liabilities have to be protected. And we protect them by taking fractions, as I earlier on said, and eventually paying out the whole numbers.
Interesting. Let me bring in Mr. Kodia Boache, Executive Secretary of the Savings and Loans Company. I mean, when it comes to banking and finance, it appears that you're always treated as the geese that lays the golden egg. For you, what is the situation now? And can we say that the impact to be minimal if this whole bond exchange program is implemented for your members?
Okay, thank you very much, George, and your viewers. And my regards to my fellow panelists. We are in a situation where we all need to take an action. Deciding not to take any action is not the option. Fortunately, when it started coming, we had engagement with the fact-finding committee set up by the government. We met with them, we shared our views with them and as to how the whole thing will impact the system. We also fortunately had the opportunity to meet with the regulator, that's the Bank of Ghana, to discuss and also to hear from the central bank. Fortunately, the central bank has put in place some measures to support the institutions who are exposed in this particular arrangement. One, to protect their balance sheets. Two, to also support them as to advise and also some of the regulatory requirements. And you know, for a financial institution to continue in business, the regulatory requirements are very key. Your capital adequacy requirements, your liquidity requirements, and then also you have to look at your ability to serve your markets promptly. Most importantly, had to also do with the confidence that your depositors or those who are holding your liabilities have in you. And therefore, where we have gotten to with all these engagements, the customer is very key in understanding what is happening. And this is where we think that we all have a responsibility in understanding the dynamics of this whole program. So from where we sit, we will continue to deliver our service as we will continue, we have continuously been doing. You know, for savings and loans companies, we take deposits from the public, take borrowings from the public, add it to our capital and grant them as loans, and also keep some of the funds in investments so that when the depositor comes that he needs his money, we'll be able to pay those ones. What is very worrying now is that we have not gotten to any imaginative point where financial institutions like banking institutions are saying that they have this kind of challenge. However, depositors are rushing to taking their fixed deposits.
Is that the situation? And sorry to cut you in. Is that the situation now?
Yes, those who don't understand what's happening.
There's a rush or a run to liquidate their fixed deposits.
They are rushing. Yes, they are rushing to take their deposits. And unfortunately, those who are also owing the banking institutions are defaulting on their loans. And so we think that we have not gotten to the point where we should be experiencing this. And therefore, we all need to support the system. And as I said from the beginning, doing nothing is not an alternative. We all need to take pragmatic steps to protecting the financial sector. And I always say, if your banking sector or your financial sector is weak, then your whole economy will crash. And therefore, we all need to take steps that will protect the sanctity of the financial sector.
Mr. Kodia,
sector, the insurance, and everybody.
Mr. Kodia, what could be the impact again on going forward about credit extension as well? Because And again, I'll use the word all other things being equal. If government still stick to its proposal right now, you will get 0% on your government papers next year. How would that also affect your ability to again grant loans to these small sized businesses and individuals like me next year? Does it mean that let's forget about credit extension? Even though government has talked about a stability fund, we still are yet to get fine details of how it's going to work.
Okay. One, if institutions are not able to implement contingency plans as the central bank has directed, then they will be having challenges with liquidity to continue to grant more loans. However, what we have seen is that institutions that have close relationship with their depositors, institutions that continue to grant micro to their customers, they are continuously granting loans. Again, the central bank has given the assurance in sector.
Having some bit of a challenge,
Yeah, they are going to support the system. And so the fine details we are yet to receive from the central bank as to, and if you look at the statement that the Financial Stability Council issued out, i.e. the institution of the stabilization or the stability fund, when the fine details of this fund comes, it will help the players as to how to go forward. And so my main point here is that there is no need for us to rush. There is no need for us to take any panic reactive action. Rather, let's exercise some restraints while the players, we continue to engage the regulators, all the players within the banking space, and also waiting for the fine details of how the fund will work and how it will use to support us. In any case, a stress testing has been conducted in the banking sector, and therefore the central bank knows the exact gap that
has to be filled.
The sector needs to be filled. And so let's all exercise some restraints. Let's submit views that will make the system better to protect our own investment. And I keep saying, this is just like somebody who has come to you to take a loan. You have granted the person a loan and the person has lost his job. And the person comes back to you, the financial institution, to say, I've lost my job. I'm unable to pay the loan. And it happens to most businesses. Will you, the bank, say that I care less, or you will care about the misfortune of your client? This is where we have gotten to as a country. We all have a responsibility.
Yeah.
Whether we like it or we don't, we need to take an action that will save the system.
Interesting thoughts there, Mr. So I'll be coming to Mr. So very soon about the way for when it comes to corporate trust. Because for you, when someone is retiring, when someone is moving on, they want their money and they don't care. But I want to bring in Professor Eric Osei as an economist. For you, looking at all these submissions, should government quickly go back and look at its notes again, and even the fear about the contagion effect and all the rest? Well, let me get your preliminary thoughts on these developments and what should be done going forward. Professor Eric Osei is an economist.
Well, thank you very much, George, and let me say good evening to my co-panelists. Yes, I think we are in a very difficult moment, but I describe this situation as we have just like somebody who has to undergo a surgery, right? I mean, you have to take it as being on a surgical bed. If you don't do it, there is consequences, right? You have some effect on your body, whether you can die or something else will happen to you. And if you do it and you don't do it well, there's also some consequences that it will come to you, right? So Whichever way, if this is going to kill you, then perhaps you have to make sure you do it and do it well. You do the surgery and make sure that you do it in a way that you will survive. And being able to survive will mean that both the patient and then the doctor has to cooperate to ensuring that the surgery is successful and each party will be happy. Otherwise, each party will end up not being happy. So I like the stance of Mr. Tribu-Akudia that this is the time that all the parties, all creditors, governments as a debtor and creditors will all have to understand the current situation and then look at the net.
Having some challenges there connecting Professor Eric Osei-Sibi, but we'll come back to him very soon. But let me come to Mr. I mean, for you, what is the way forward? Because it appears that you are also moving hard to protect your business and your clientele. Government appears to take, I won't use the word entrenched position. For you, what is you think is the way forward? But let me let Prof wrap up quickly. And Prof, you're making us the way forward for you. What should government be doing right now to deal with the situation?
Yeah, I think what government should be doing, like I said, we need to look at the net benefits. And the net benefits to the economy, comparing it with the costs of doing nothing. If we don't do anything, the economic disruptions that will ensue will mean that perhaps we're not going to get the economy to support any business. But if government chooses this way, then it has to make sure that it does it well. It has to make sure that it is more inclusive and it is also transparent. The process is transparent enough to making sure that all players will come on board and there is burden sharing across all actors. If that happens, then you are going to make sure that you are going to have a successful debt restructuring. And you should also make sure that, as we have said, you will definitely will need a prop, an emergency system in place, a complementary system that would come in to support banks and non-bank financial institutions that may experience some kind of panic withdrawals or deposit outflows or capital outflows and what have you. Now, if you have that in place to mitigate the risk that will come, because definitely there's going to be some kind of risk to the financial system. Banks are going to suffer on their liquidity, their capital adequacy ratios are going to go down, they are going to encounter breaches, liquidity breaches. They have to make provisions for some of the debts, and so the IFRS provision have to be checked. The capital requirement ratios will have to be checked. Capital adequacy ratio will have to be checked. Liquidity ratios, all the macroprudential requirements would have to be looked at, and then the pension schemes, their withdrawal, they have to be able to know and look into the future, how much withdrawals that they will need or gaps that will be created as a result of this restructuring, engage the gap. And so it is good that there's this complementary action that is coming from the regulators and from the Financial Stability Council, because that is what is important. If what they are saying comes to fruition, like the 15 billion that the Fiscal Council is promising with the support of development partners, then I think that we have to remain calm, because we have seen it elsewhere that they have been able to go through this kind of restructuring and they have been successful. If we take any panic action and we don't support the system, there's no way it's going to work. But then if we are calm and do the mathematics, do the projections, and look at ways of making sure that we reduce the impact, being more innovative in terms of how you are lending, in terms of your cash, your expenditures, in terms of your deposit mobilization, in terms of how you keep your liquidity and everything else. I'm sure we'll be able to come out of this. The whole idea is to ensuring that at the end of the day, government debt levels reduces, it comes down to sustainable level, the macroeconomic environment becomes more stable, businesses, interest rates, and others begin to come down. If these things happen, it will inure to the benefit of all the financial actors, right? Because then the economy begins to pick up, and then people begin to get confidence in the economy, and then investment begin to come in, lending begins to go out, and this together will ensure growth. And so we are in this together. That's how I see it. We can always look at the negative, but I think the time has come that we have to look at how do we go out of this? How do we become more innovative in these difficult times? How do we reset our operations to ensure that we remain resilient in these difficult times? I'm sure if the attention is shifted on that, there's no way we will not come out of this unscathed, and we, all of us, will be better at the end of it. That is how I want to
Let me come to Mr. Hussein, and I know that even in your recent engagement, you made some proposals, and some of the organized labor, the medical association, came back and were very hard on you. I mean, how are you engaging your members in these times that just don't want to hear anything? I am going on retirement. I want everything. How are you managing it?
Well, thank you very much. I think when we started communicating, we have really tried to calm the anxieties that have engulfed the contributors to pension schemes. I think, in all the communication that we have had, you are aware that we have really tried to do that, because there is a lot of anxieties among the contributors as to what is going to happen to their funds when they go on pensions.
But this should it have happened? Because some was expecting that there would have been thorough engagement.
Yes, of course. That's why I like Professor Sibe's, how do you call it?
Submission.
The submissions.
Yeah.
But what also, he made me also feel a bit as if all the debtors and the creditors were actually engaged, and all of us agreed that this is the program that we should have, because we are all interested that we should share the burdens together. But that did not happen.
Yeah.
This proposal was one-sided.
Yeah.
We as the market players, as the pension industry, the insurance industry, were not engaged.
And that defeats the whole argument about
of course,
a bond.
Of course.
It's an agreement between two parties.
Yes, because Professor Sibe understands that a bond actually is an agreement. There is always a price guidance that comes out. There is offer made, there is an acceptance, there is a consideration, and then the agreement becomes, valid for everybody who actually bought into that bond. And so if you want to review the terms of that agreement that you and me have agreed and signed, I'm sure that you should be engaged. This is what is happening. Can we all engage to see if you can arrive at any other agreement that would be good for both parties? But that was not done. That is why we actually rejected this, because we need further engagement on this, because this was going to affect the pensions industry. And I'm sure he's done his computation and he knows how much this is actually going to affect the pensions industry. Like he commented also, GMA have come out. I've heard the news bulletin where they even made a statement that we are on our own because the chamber is ready to renegotiate. But the point is that rejecting the deal as it is, that is the first step, that we have rejected it, because it's not good for all of us, the pensions industry, including GMA. GMA are significant partners in this pension industry, because they have the health workers and we have the public sector workers also. So they are very significant. But the first step is to reject. The next step is to have an engagement with the Minister of Finance. And then when we put across our concerns, we believe that the Minister of Finance may even understand that, no, pension sector is a very special industry that may even need to be ring-fenced for this whole debt structure.
But every industry is important. Trying to play the devil's advocate
I
here,
agree with you.
that if you are a bank and I'm a business, and I insist on playing the devil's advocate, and I'm having challenges in settling the debt and paying the loan, obviously I'll come back to you to renegotiate that.
Every sector.
And closing the door to, we will not accept it, this it's a real terrible situation.
Every sector is very important.
Yeah.
I heard Mr. Classy, the
From insurance industry, raising very critical
and
issues.
he says that the insurance industry is dead if this program is accepted as it is. And I sympathize with him very much. And what happens to our industry also? I mean, the economists can also play into it. There could be loss of jobs because if they are paying zero coupons, how do we keep the level of staff that we have now? I mean, there could be loss of jobs. That also affects...
That is a reality.
That is also a reality.
Loss of jobs.
I mean, it affects the economy. Then perhaps government's projection of revenue, maybe from direct income, is also going to go down. So these are all the mechanisms I believe that we should all look at it very carefully and see what could be the best possible outcome for both industry and government. Because the government says we are in it, we are all in it together. I don't think the proposal on the table shows that we are in it all together. This shows that I have done this, you either take it
or leave it.
So why are we in it all together?
It will be a good time for us to take a short commercial break as we look at, that is, this debt exchange program, the impact on the broader financial industry. I've been speaking to Professor Eric Sesbe, is an economist. Mr. Classy is president of the Ghana Insurance Association, and also Chinebo Akodia-Boakye is executive secretary of the Savings and Loans Companies. We'll be right back after this break. As we come back, what is the way forward to try and make some progress on this issue? We'll be right back after this break. Welcome back to PM Express Business Edition, Debt Exchange Program and its impact on the entire financial industry. Is it at risk of losing out in terms of market confidence? So as the Executive Secretary of the Corporate Trustees with me in studio, Mr. Classy is the President of the Ghana Insurance Association, Chinibwako Diabuachi is the Executive Secretary of the Savings and Loans Companies, and Professor Eric Osesibi, he is an economist. Let me go to Mr. Classy. And for you as an insurer, let's look at the way forward. I pray that you're also not being hit by a situation where people are coming in for their fixed deposits, looking at the way your industry is structured. But for you, the way forward to ensure that, listen, we correct the situation right now before it's too late.
I think that I'll start from the analogy of Professor Osesibi, where he talked about it's a situation of a surgeon and a patient. I'm not a medical practitioner, far from that. But I think we all know that before a surgery is conducted, you might have to look at the vitals of the patient. That is why in our industry, it's a completely different situation where our peculiar situation would not necessarily allow this type of debt exchange. I'll give you certain figures. As at the end of the third quarter, our gross written premium was about 4.5 billion Ghana cedis. What we call the underwriting loss or the technical results was in excess of 356 million Ghana cedis, which just says that we are paying much more claims and expenses in excess of 360 million more than the 4.5 billion that we have collected. Then if you then come, how we are able to even pay such claims is that I initially mentioned that we take fractions and then we pay out whole numbers. We invest, we are directed by the regulator that go into government instruments. Out of all those investments with all the other things that we got, for the same period of up to the end of the third quarter, we made a profit, interest income, maybe about 805 million. So which means that about almost half of what we have to pay had to come from such interest income. If you come, I broke out the figures for life and non-life. For life, for instance, they have to make payments on a daily basis, on a monthly basis, because as the economy deteriorates, people go in and surrender their policies. They might not necessarily even be dying because there's an investment component over there. Yeah. They need in excess of 1 billion to pay for maybe 2023. If they're supposed to be paying 2023 1 billion, and then the general business, I'll give you a classic example of how our expenses are going when you talk about the depreciation of the cedi and then maybe inflation. Take it that in January you bought a vehicle for $100,000. You came then you insured it at 6 cedis, so it was like 600,000. You drive out in that same day. If you had an accident and the cost of repairs is about $10,000, you are going to be fixing that vehicle in Ghana cedis stamp up to about 60,000 Ghana cedis. Today, because you bought a policy for 12 months, so from January that you insured that vehicle for 600,000, if there is that same loss that the cost of repairs is $10,000, insurance companies will have to bring out about 130,000, which is an additional 70,000 that we didn't envisage or anticipate in January when we took up that policy. So continuously, liabilities are falling due that we need to meet on a daily basis. You could actually look at these figures as we are saying that we have underwriting losses of 356 million. From now up to 31st December, if there is a significant loss, you need to make provision for that. That wipes away the entirety of your interest income, which I said was 805 million Ghana cedis. Then how do we pay our claims if for next year we are getting zero interest? Effectively, it means that, okay, we are not going to be able to pay our claims. You look at the life people who people keep surrendering. People are dying and they're making claims. The policies are maturing because they've come to term after the number of years. Then where will the money come from? So I think that we need to look at industry-specific peculiarities as it relates to this debt exchange. There's not any one-size-fits-all. It wouldn't be anything that we'll be able to do.
Okay. Mr. Chinibakude, I mean, for you, as we try and wrap up, for you, what should be done now, I mean, to save the situation so that things doesn't get out of hand?
Okay, thank you very much. One, the engagement should continue. Number two, I don't think each party should take an entrenched. Let's continue to dialogue to come out with the best solution that supports progress. That I see that what we find ourselves in is going to bring out our innovativeness. Institutions are now going to make sure that they innovate to survive. Now,
having some challenges there. Let me bring in Professor Eric Osei-Sibe. For you, as you also try and wrap up, let's wrap up on that is Chinibakude in terms of the way forward as you wrap up on this program. Yeah. Having some challenges there. Professor Eric Osei-Sibe, for you, what should government be doing now to try and save the situation so that things doesn't get out of hand?
Yes, I think that two key things. One is to making sure that it put in place measures that mitigate losses for banks and the non-bank financial institutions. That is non-negotiable. Those policies have to be strong enough to support the financial system from collapsing. And the other thing that the government should look is to making sure that there's collective action, right? Look at the collective action clauses in domestic debt contracts and making sure that it brings everyone on board and takes everyone's view into consideration. But as it were, I don't think government can yield to the various demands that will be coming up, because I mean, if you give out too many concessions, it means that you're not going to have the effectiveness of the program, because as you know, there's a gap in the fiscal situation that government is looking to close, right? And it will require some amount of debt relief to be able to make sure that we work back better. We are able to restore fiscal sustainability so that the economy will pick up. If there are too many concessions where everyone is saying that, well, we cannot stand on this or we cannot go with this, although they may have good, case to make, giving in to many of such concessions may mean that you will have to prolong, or we all have to prolong, the economic turmoil that we're currently going in. But if we can buy the bullet right now, okay, I think we should, so that we are all able to build back quicker, so that the economy can be able to pick up, and all the businesses, the financial system, and everyone will begin to pick up. Otherwise, we're going to prolong this, and that really will not going to inure to anyone's benefit. So much as government might make sure that the collective action clauses are activated and bringing everyone on board, making sure that the process is transparent, the process is inclusive, and all of that, the various actors must also understand that we are between a rock and a hard place. You cannot yield to one party. Of course, it's true that the actors are not the same, and therefore you cannot paint all of them with the same brush, but they must also understand that there is a huge gap that has to be filled. If you are not able to do this successfully, you better not do it at all. Like the surgery analogy that I gave.
Okay.
If you cannot do the surgery properly, then you dare not do it. I think the patient will be better off, remaining like that than you going in do it anyhow and then worsen the case.
Prof, I want us to wrap up because of time constraints and just give you in a minute wrap up in terms of your final thoughts. But also, I want to ask you, Prof was my lecturer at University of Ghana, Legon, and you taught us about government bonds being the safest. Does that analogy still hold? Do we have to revise our notes?
Yes, I mean, the recent, developments perhaps kind of give us cause to all of us to look at that kind of situation again. I mean, with the advent of the pandemic coming in and the systemic risk that it brought to governments, we have wars that are coming in. We have force majeure, weather conditions, climate crisis, and all of that clearly means that perhaps government bonds may no longer be a safe haven, right? It definitely would be have exposing oneself to some level of risk, and it's now all over the place. Government fiscal, situations are now very weak. The debt levels are increasing across board, and governments have become more vulnerable than ever before. And so it may not now be that. That is one thing that I keep telling financial institutions, that you don't put all your eggs in one basket. You have to diversify, look within the economy, provide credit to domestic investors to expand the economy. In that way, if the economy expands and the productive sectors grow, your income levels are much more sustainable than the easy way out of always giving government your monies to government. Of course, you get the interest, but you still expose yourself to a lot of vulnerability.
Mr. Chiribaku, you have 30 seconds. Your final thought, 30 seconds.
Yeah, thank you very much.
30 seconds.
We all have a responsibility. Yes, we all have a responsibility to make the situation better. Number two, financial institutions should continue to keep their eye on the wheel and engage their customers, serve the interest of customers, and we know we will come out of this situation.
Mr. Classic, 30 seconds, your final thought, 30 seconds.
Definitely, there has to be continuous engagement. But then I do not think that the industry that I belong to is being adamant. But then it's because of the peculiar situation we find ourselves in. Yes, there's going to be engagement. For instance, they're talking about the stabilization fund. Maybe then we can all see that our claims to the stabilization fund to take care of until we are able to get some interest income.
So your final words, 30 seconds. Sorry, it's a time constraint. 30 seconds.
Thank you very much, George. But let me just point out also that because of the inflationary pressures, pension funds have already lost values to the tune of about 40-something%, as you are aware. And then if we are going to take this debt exchange program in the form that it is, then we are estimating that pension funds will actually lose value to the tune of 68% again. I mean, take a classic example that we have a property that we are selling for 100 Ghana cedis, maybe last January, and then all of a sudden in December, the value of the property falls from maybe 100 Ghana cedis to 32 cedis. That is the value that we are losing, and that is why we have come out and said that we have actually rejected this proposal as it is on the table.
Well, also we have to draw the curtain down on PM Express Business Edition. Time wasn't our best friend as we looked at the debt exchange program and how that would hit the entire banking and financial industry. My name is George Wiafe. Have a great day.